Hello everyone, Clifford Bennett, Chief Economist at ACY Securities. And can I just be entirely clear about something? The only reason the stock market's been going up, the equity market in the US, Europe, Australia has been going up is mood, sentiment, hope, the need to put the money that's coming in every month somewhere. And so even if it's only 10% goes into equity markets, it's still equity market buying, but it's been more like 30, 40, even 50, 60% for some funds seeing some miraculous global economic turnaround. It's becoming ever more evident that that isn't going to happen. You've heard me say this before, but we've had further evidence in economic data out of China over the last several days. The Chinese economy is continuing to slow. The soft landing I thought we were finding is going to be a little bit lower even than where I thought. So I think China's going to be fine domestically, but in terms of an engine for global growth, less so. And that's a real worry when Europe is going into a deep, dark recession. It's inescapable. Look what's happening there. Germany's already in recession. The largest economy is already in recession. The second largest economy, France, is having huge public unrest and disorder. And I don't think these were isolated demonstrations. The financial media has not been reporting what has been going on there for several months now. Pitched battles between firefighters and police deserting to join the demonstrators. It's a real kind of civil war matrix mix at the moment. So, it's not a civil war, but it's really got the elements now. And there's uproar in Parliament as well. So there's parliamentarians who are, chanting against the government in Parliament. There is real discord in France. And it's for a host of reasons. And yes, the tragedy of a teenager being killed recently should never have happened. But there are deeper issues which this simply lit the fuse to. And there is a massive anti-war, anti-NATO movement happening across Europe. Whether you like to hear that or not, that is definitely happening. There's incredible unrest in Netherlands, and they've just had a big change of government where the farmers ran against the sitting government and won. You've got massive demonstrations in Germany. You've got tanks on the street in Zurich because of the spillover from French demonstrations into Switzerland, and the unrest starting to rise there as well. Who would have thought? These things are real. These are not exaggerations. These things are happening. So, in that environment, how much shopping do you think the French consumer is going to do? This is why sentiment indices across Europe for business and consumers are at crisis levels still. They might have the odd occasional bounce, but they're at crisis levels. Businesses and consumers in Germany, France, and across parts of Europe. Spain, I think, could be spared here a little bit, and Italy might kick up a little bit too. But generally across Europe, there's going to be a slowdown in consumer activity and business activity. This is all while they try to manage a tremendously aggressive shift to a lower net zero outcome, which is really causing companies a lot of expense, and it's diverting a lot of potential productivity that could have been there to drive normal economic behavior. Now, we all want a better environment, we all want a better climate, but it may be being done too aggressively for those economies to bear at the moment. So there are a lot of stresses there, as well as the sanctions against Russia really hurting their energy prices still, and as well as, the risk of war there in Europe. As Poland had recently suggested that NATO actually get involved and send troops into Ukraine, and that was defeated only by a few countries in the EU vote. So despite huge public unrest and activity and expression against any such move. So there are real stresses in Europe at the moment, in the same way that there are real stresses in the United States political system at the moment. President Trump on charges. President Biden very close to being charged also to do with what his son has been doing, and his son has already been charged with some offenses. There's a lot happening there in the background in congressional committee meetings and their findings being published against the Biden family in general, including President Biden. So that polarization, that distrust is only going to get worse in the United States. And this is all while their economy crumbles and the sitting president, says they have a strong economy. In other words, there's no economic policies coming to rescue the economy from this downturn, because the sitting administration just wants to push that it is a strong economy and the rest of the world wants to be like the United States, as if. So what I'm saying is economic problems that will not be attended to means things will deteriorate in the US economy. There is no doubt about that at all. China is slowing. Europe has massive unrest. The UK is in dire straits, and in the economic data you're going to see over the next 1 to 3 months out of the UK, it's not going to be a pretty picture. So the Western economies of the world and China are China's in a slowdown, but the Western economies are in trouble. So where does that leave you on buying stocks and asset prices? It's not a good outcome. Sure, excess funds, and even, the market could even rally on fear, the US stock market, because a whole lot of people around the world might go, things are really ugly, but if I put my money in the United States, if I put it with the US bank, it's guaranteed by the US government. And for the moment, that's still steadfast. So that's a possible activity. That's why the US dollar could be bought. And it's why, US stock market could be supported for the moment. But the underpinnings, the fundamental underpinnings of this stock market rally are now very delicate indeed. And inflation is going to remain stubbornly high, and the Federal Reserve is going to be tightening, or at least maintaining a tightening bias. And as I forecast 18 months ago, we would go to around 6.5% on a Fed funds rate, and we will stay up there for 12 to 18 months. And we've had that forecast for the last 12 to 18 months, and now everyone's starting to recognize that that's possible, but we forecast it when no one else could see it. As with the Australian interest rate situation, we forecast 12 to 18 months that the Australian cash rate would go to 4.5% to even 5.5%, that it would be a massive mistake, but the RBA would do it anyway, and that this would send Australia into recession. I was on ABC News prime time 9-10 months ago saying exactly this when no one else was saying it. And I say to you now that the US economy is in trouble. It's going to get worse. The Australian economy is in trouble. It's going to get worse. How do you feel about your stock market holdings? Use the instruments you can use to play defense, or at the very least, have in mind a scenario, a strategy in advance, because it can be very difficult to think and act in real time, smart enough and fast enough if you haven't pre-planned a strategy. Have a strategy in mind with how to deal with what if this view is correct and we're going to have further significant economic slowing in the Western economies. Where does that put Western stock markets, equity markets, and how are you going to manage that risk? It may not be that you have to sell all your stock portfolio, but it may be that you have some stop loss orders in terms of indices and other financial market instruments to protect your portfolio should the equity market begin to melt down from here. Stay tuned, because we're at a very interesting point now. Fed minutes coming out are likely to be more balanced in debate than they've been for a while. So perhaps less hawkish, but still hawkish, and that could worry the market. Also, we've had the 4th of July holiday in the United States. Everyone's having it's always a psychological, emotional reset time for the US market. Just be careful over the next 1 week that real decisions could start to flow through the market that are more defensive than we might have anticipated. I hope this helps. Have a great day. Clifford Bennett, Chief Economist, ACY Securities.